Michael?
All right, Paul. Paul?
And not a great start to the second half of the year on the TSX, as few sectors are in the green. And for a look at the third quarter, and how it wrapped up, and some of the strategies to take with you into the final 3 months of the year, we are joined by Dana Avigdor, who is the head of trading at Barometer Capital. Good morning. And if you could perhaps give us a wrap-up for the third quarter.
Okay, so the third quarter, it depends on what you consider relative positives versus negatives, because the only positive sector was the utilities index, followed by the consumer staples and telecom, which were down 1.3 and 1.5. So the top three performing sectors, only one was positive, two were negative, and of course the other sectors were more negative. So, it has been a tough quarter. Across all sectors. I guess the one takeaway that you can take from it is that the sectors that have relatively outperformed and down 1%, let's call it flat, were sectors that are defensive, and that's in line with what's been going on the last quarter. The S&P is closing down closing down, that's one more day, but so far down in a quarter over 12.5%. So it's been a tough quarter all around, almost all sectors, except some yield stocks.
Oh, yeah. Now, the best yields of the quarter actually are really not much better than long bonds, right? What's going on there?
Well, there are some sectors that are yielding a little bit higher than the long bond, and actually, and that's what's supporting them. The REITs, some telcos, even some banks, but the banks have some other issues. We prefer some of the REITs and telcos and some utilities for a yield pickup, and they can return anywhere between 4 to 6%.
And what about with a pullback in so many of the various sectors? Are there certain sectors that look overly appealing to you just because of the pullback? There's some sound bites and some data that I can give you, quite a lot, that will show that almost everything is oversold. But the question is, at what point do you step in? There would have been a lot of times during this quarter where you could have looked at some of this data and said, oh my, it's so oversold, and then you would have plunged again. The volatility is immense. The correlations are huge, and that's a big point to take away here, is that correlations, implied correlations, which is the relationship between stocks to each other and how they move, is at a 20-year high. At over 90%, it spiked up the day before yesterday. Yesterday it came in a little bit. But what that means is that there is no real stock-by-stock movement. The stocks are not moving because on the merits of their businesses. They're moving on a macro, broad stroke type of trade because of the macro situation. And even cross-asset correlations, stocks with bonds, or stocks or markets with oil, or U.S. market with European market, the correlations there are extremely high, which means that there is no degluing of this globalization. The whole move is one big trade across all global markets in almost all sectors. Gold is still up year to date. What about the banks? With the banks having pulled back 10% or so, yet they do look the best potentially in the global scope. Would you be tempted to step in on that front?
So our banks are definitely, the Canadian banks definitely do look a little better than the U.S. banks, but here is the issue. The issue is that the yield curve is flattening. The issue is that with the market doing what it's doing, there aren't that many IPOs and bond issuances. The high yield market, especially in Canada, has not been very active in terms of issuances. So banks make money in that kind of environment. They're not making money on that front right now. The trading, there's been very volatile and not very lucrative, not very profitable, as we've seen in the last quarter. They don't have much growth. Loan growth is not really that big. And with interest rates low and staying low and the curve flattening, the spread has also narrowed for them. So there's no growth, and there is a global banking crisis. And while our banks are better, we don't feel we have to pick away at it yet. And at Barometer, we're style agnostic, so we like to go
to what the market prefers, where the strength is, and right now we don't see that that money flow going there yet. So we prefer to still be in capital preservation mode. At times we have high cash. Don't underestimate cash. Do not worry about picking bottoms, because just like you can't pick the top, you can't pick the bottom. So even though we're oversold, there are some metrics we want to watch and some things that we want to see turn around before putting new money to work.
Just briefly, in wrapping up here, Diana, the KCJ Index, you want to show that you find some value in this index. What is it?
No, actually, the KCJ Index is what I'm showing. Look at the correlations. That reflects the correlations between stocks. Until that comes in, that is a testament to the fact that everything is one big global trade. That means that all stocks move in tandem. That means that no matter what great business you're picking to invest in, chances are that it may move in the same direction as the rest of the stocks, despite the fact that it's an excellent business. So this is a kind of a measure of fear also. So that needs to come down a little bit in order to show some alpha in your stock pickings.
Okay, great, Diana. Thank you very much for those thoughts. Very interesting. That was
Pleasure.
Diana Avigdor, who is the head of trading at Barometer Capital in Toronto.
All right, so our top story of the day is that we're waiting for our top story of the day. It's the gross domestic product numbers for Canada due out at 8:30 Eastern Time, which would be about 50 minutes from right now. That's the top story. Some of the other stories we're following for you at this